G'day folks, welcome back to another weekly update for the markets, and we've had a pretty volatile week in the week just gone, but in the end markets didn't end up going anywhere too much. The S&P was around about flat, and we seem to be getting back into the old pattern again of the Australian market doing worse. We ended up down around about 80 points. So let's just check on the general information disclaimers, just to reinforce that all of this information is for you to make up your own mind about what trades or investments that you might make. And so the action for the week, the S&P was steady. I think the odds favour that we've still not reached the bottom yet. That's based on the charts, so looking at it purely from a technical point of view, I think there's still a little bit further to go yet. And we'll have a look at those charts in a minute. But you can make a very negative case. This is where I'm really in two minds at the moment. If you look at it from the fundamentals of what's going on in Europe, the US consumer and the US housing market, and the fact that quantitative easing, which is the Federal Reserve basically buying bonds, and they're about the only person in town who's buying US government debt at the moment, that's ending in another 10 days' time. So you can look at all that and say, well, you know, gee, things could be really, really bad and the stock market could fall. Yet you look at it from a sentiment point of view, and this tends to be, from my perspective, much more reliable from a trading perspective. The sentiment is pretty ordinary. There's a survey in the States called the Investors Sentiment Survey, and it's down around about 25% and has been for some weeks, and that is very typical of low points in the market. The bullish percent index is down now into oversold territory, so it could go a lot further down yet, but certainly you could make a case for the market turning up from here. So the fundamentals are overwhelmingly negative. The sentiment is at a point where you could expect a bottom in the market, and the charts are saying we may have bottomed, but maybe a little bit more to go. So it's a little bit of a confusing picture at the moment. Gold finished roughly $10 higher on the week, and is still holding a medium-term uptrend that we'll see on the chart in just a minute. Silver still forming a base, and ideally I'm looking for $30 to $32. I've lowered that just a little based on what I'm seeing in the charts. And then we turn to the ASX 200, and we closed down 80 points for the week, even though the S&P finished flat. And we're sitting on key support, and I must say the ASX 200 is looking very suspect. And so are the sector indices as well. And as per last week, the monthly trend has clearly broken to the downside, and so that's indicating lower down at this stage. So let's have a look at some of those charts. So first of all, this is the US dollar index. So we'll just pan back and have a very big picture look. So dramatic fall over the last 6 or 7 years. We're tracking now down towards the all-time lows, down around about 71. It's very, very, very negative. A lot of people are short the US dollar, and why wouldn't you be? But I just worry a little bit that when something becomes almost accepted trading procedure, and that's been short the US dollar, that generally the market can find a way to do something different. So it's possible we could see a US dollar rally from here, particularly with what's going on in Europe. And if that was the case, then that certainly would affect the stock market. So at the moment, we've had plenty of volatility up and down, and I think you can only say that that's really going sideways at the moment. Let's look at the S&P. So we'll have a look at the S&P on a monthly chart. So this is the big picture. We've had one larger month down, but still nothing of the dimension of May and June of last year. So we're still holding above the 10-month moving average, which is pretty positive, and they're both still heading up. So let's look at the daily. We had I can take this one off now. That's not really that relevant anymore. So looking at the potential levels that could hold this market up, we had 1282, which we've gone below. We've now got 1248, which we didn't quite reach. We got to a low point of 1258 last week. The next level down is starting to get down into the retracement levels of the bigger run, which is basically from July of last year, and that level's 1233. So for me, they're the next two levels. It's showing signs of maybe bottoming out, but maybe one last run to down to 1248 or down to 1233. Still haven't really seen the big panic washout day, although we did have a reasonably heavy selling day on Wednesday of last week, but haven't really seen that big panic sell-off yet. I'd like another day like this. Perhaps the 1st of June would be a good day for that. And I think with the sentiment indicators where they are, that would be pretty indicative of a bottom in the market. So that's the S&P. Let's have a look now at our market. So this is our index on a monthly chart, and you can see we had an upsloping trend line that had held since basically May of last year, and then we've had the last 2 months. May wasn't too bad, but certainly June now has broken that trend line quite significantly. So just zooming in then and looking on a daily chart, you can see we've got our next level of support is down here in this 4250 type area. But you can see here with this pattern here was what I drew out a couple of weeks ago as a possibility. We'd get a bounce up into this area up here, and then we'd come off again, and you can see we tried to rally. We had a very negative day on Thursday. We tried to rally on Friday, and it wasn't able to hold it, and this level is looking really quite shaky now. So I'm expecting that we might see some lower levels on the ASX 200. Let's have a look at the finance index now to see, that's because that's certainly been doing some of the damage. And you can see here that in this line that I've got drawn in here is a little bit arbitrary. It could be here, it could be a little bit lower, so I'm not necessarily hanging my hat firmly on that particular line. It could well be that we're still holding some support on the finance index, but you can see Thursday we had a big sell-off. Friday, well, in fact, let's pan back a bit. We had a very big sell-off on the 2nd of June. It went a little bit lower. It tried to bounce. That was pretty weak, and the volumes behind it weren't all that great. We then had another big sell-off on Thursday on a higher volume. The market tried to rally on Friday but couldn't hold the gains. So you'd have to say that the odds overwhelmingly favour the finance index heading down lower, and it potentially could get down into this area down here, which would take a little time, but 37.50 is a fair way down, and that'd be quite a number of dollars off the price of bank shares. So that's that one's quite weak. Let's look at the materials, and this is the materials index on a monthly basis. You can see that we've definitely rolled over now on a monthly basis. This is it on a daily. So we've got we're just holding some key support now on this little double bottom, and again, similar kind of pattern to the finance index, where we've had a big down day Thursday, tried to rally Friday, but just couldn't hold the gains. So I'm thinking that the odds do favour some more downside. Let's look at the Small Ordinaries Index. That's this is the small orders index, the blue line, compared with the red line, which is the ASX 200, and you can see it's lost a little more ground in the last couple of months, as you would expect, but not dramatically so. So basically, the whole market has really just been underperforming. So let's go back to the presentation. So let's have a look at some of the other charts that we normally look at. This is the level, this is the chart of the copper inventory, the London Metals Exchange warehouse. So bear in mind, this is not the only warehouse in the world. There's also a metals warehouse in Shanghai as well. But this one's showing that we've seen a substantial increase in the amount of copper being held in the warehouse, and this corresponds to China basically really backing off on their purchases of copper. They were using some of their stockpile of copper, and I guess their plan was to hopefully be able to buy copper at a lower level, but there's some signs now that they're coming back into the market, and copper hasn't really lost too much ground. So you can see, just seeing a little bit of a turnover here now, so it may well be that this build-up in copper inventories is coming to an end, and we're starting to get a little bit more drawdown. And this is actually really positive for the price of copper, because if you look at the actual copper price, despite that massive build-up in inventories, the copper price since December is basically flat. In fact, it's fractionally higher. Went higher for a while, it's backed off, but for copper to have sustained that level over the last 6 months, with inventories building up as they have, just really tells you how strong that copper market is. Let's have a look at nickel. This really is pretty hard to decipher, because we've had a massive decline in the amount of nickel held in the warehouse over that period of time, and yet the nickel price has actually gone down. Would have expected it to go the other way. So there's certainly some dynamics there that are a bit confusing. This is the tin price, 2-year tin price. The fundamentals over the next 5 years are very, very strong. The price probably got ahead of itself up here at $33,000. It's probably overcorrecting now to the downside. We're now down around about $25,000 a tonne, so I guess that the right price is probably somewhere in the middle. But the long-term fundamentals for tin remain very strong. So we certainly want to keep tin stocks on our horizon. So the overall strategy, the next 3 weeks are really vital, because we've got the quantitative easing process coming to a conclusion. So the Federal Reserve will stop buying US government debt, and if they stop buying US government debt, you've got to wonder who will. So I don't think it's going to last too long, because China isn't buying. In fact, they're a net seller. I understand Japan's a net seller. So it's going to be really quite interesting, and we could see some significantly increased volatility in both the bond market and the share market. So as a consequence of that, I think markets could go either way. You never know how markets interpret information, so I'm not going to rely on the fundamentals. So because markets could go either way, I think the only way to play this is to a degree, as we have been in recent weeks, although recent weeks we've been biased more to the downside, to the short side. But I think the only way to play this at the moment is to maintain a lower overall exposure and have that exposure reasonably balanced. So some short positions, some long positions. If you do not know how to short sell, then I suggest that you have very little long side exposure to the market. But I really would encourage you to, if you've had a difficulty with short selling, then please contact us, because there's lots of support here to help you with that process, and you've been missing out on some fabulous trades to the downside. So that would be my advice: lower overall and keep your exposure reasonably balanced. Short selling the weaker stocks and looking to buy the longer ones. So how do we actually achieve that balance? Obviously buying the dips to support on the majors. We're starting to come up onto good support levels now on stocks like BHP, Rio, Woodside are not too far away, so we'd be looking to buy those dips. In a slightly more medium term, I think we will get a rally at some stage, and that'll be an opportunity to short sell the retailers and the banks and the other stocks that we've been shorting. And I think at this period in time, I just cannot find a rationale for buying small cap stocks at the moment. I think we've just got to continue to sit and wait. As I've said on many occasions before, the small cap market, sometimes it runs for 6 to 9 months of the year, other times it only runs for 4 to 6 months of the year, and the rest of the time you've just got to sit and watch with very little open, because there's no point in trying to make money out of small cap stocks when the liquidity is not there. So overall, just looking to carefully rebuild into resource stocks. Gold and silver is probably where we're going to be looking first, but certainly buying the dips only. So that's the best summary I can give you at this point in time. It's a little bit more of the same, but I really see the next 3 weeks as being quite volatile and perhaps quite dangerous. So just be patient through this period. I think the next 3 weeks will tell us a lot. So that's the next week until QE finishes, and then the first couple of weeks of July to see how the market's going to respond to that. And I think we'll then have a pretty good idea of how the market's going to treat the next 6 months. So that's it for this week. We'll talk to you next week. Cheers.